guys, it's CJ Investing here. Welcome back to my channel. And today I'll just be talking about what I've been doing lately in the stock market, any potential moves I'm hoping to make in the future, and just my whole investment strategy. And it's probably going to sound like rambling, but this is just what I love to talk about, investing. So I think we finished Friday in the stock market. It was pretty green. I think the indexes across was up about 1%, maybe a little bit more than that. Everything was pretty much green. I don't think there was much red, maybe besides like Stanley Black & Decker or something like that. Ticker symbol SWKS. I looked at that stock before and I thought it was something, but I looked at the financials and I thought about the innovation. It's been around for a very long time, and it just wasn't for me. It's just not a good investment for me. And I always encourage people to do their own research. Invest in companies that they understand. Usually it's the bigger market cap, more popular ones where people tend to understand more. But as you know, I'm a dividend investor. I look for dividends is a big thing that I look for, but I also look for a little bit of growth. If I can get any growth, it's always good. Companies like Johnson & Johnson, Procter & Gamble, Colgate Palmolive, I think that's how you say it. I'm not good at pronouncing that, but those companies don't have a whole lot of growth. They're already very big in market cap. I think Johnson & Johnson is like 300 or 400 billion. That's how much they're worth. So even if you look at the analyst projections for the coming years, you're not going to get very much growth with that company. People invest in Johnson & Johnson, of course, for dividends and dividend growth. They're very consistent dividend raises. I think they usually average about 5% per year on the dividend raises, and they're yielding around 3% or so. And that's the company that I'm thinking about adding back to my portfolio. I had it once back when I started investing back in like 2020, but it was just too boring for me at the time. And I know investing is not supposed to be exciting, but when I look at a company or I think about a company, I want to get like some kind of spark. I wanted to feel something. And at the time, I was into more growth investing and trading in and out of stocks, which I've been trying not to do, reacting emotionally or anything like that. I've gotten a lot better at it. And I switched to the dividend side of things. But back then I was interested in the SPACs, the special purpose acquisition companies, because there were a lot of SPACs at that time. A lot of companies was going public. That was just like the popular thing to do at the time, back during the pandemic when it first hit. But a lot of companies' valuations was just way out of line. After that quick drop in 2020, March of 2020, the fastest drop in stock market history, the market came back really, really quick. Actually, over the course of a year and a half, it came back, and in 2021, it skyrocketed. Like, I think it reached its peak. And then 2022, it went kind of back down, and into 2023, where we're at now, it's kind of up and down, but it's went up over the past few weeks. But regardless of if the market is up or down, it's always a great opportunity to invest, as long as the company makes sense for you and you've done your research on it or your due diligence. So some metrics I normally look for when looking for a dividend stock, like Johnson & Johnson or Qualcomm or Taiwan Semiconductor, or CVS. I look at their balance sheet, of course. How much debt do they have? Their assets to liability ratio. Do they have more assets than liabilities? That's something you want to see. That's something you want to look for. I go on the internet and I look for what's their return, what's their ROIC. What are their returns looking like? How is the management team investing the company's money? How well are they investing it? What return are they getting on it? So I think ROIC is a very important metric to look at, so you can know the value that you're getting. It shows you like all the previous years what their ROIC is. Like it may be for a company like Johnson & Johnson. I didn't check theirs, but normally I would think it would be pretty low. It would be like under 10% or something like that. If you could get over 10, 15, in some cases 20%, that's really good. That's what you want when you're investing, because you know your money, you're gonna be getting, most likely, because nothing is for certain, you're gonna be most likely getting a good return on your money. So it's a good investment probably. And other things that we look at, if I'm looking for a dividend stock, I look at their dividend history. How long have they been paying that's say dividend? Are they a dividend aristocrat? Are they a dividend king? But a dividend aristocrat meaning they've been paying for about 25 years, I think. Dividend king, I think, is 60 years or something like that, 50 or 60 years. But yeah, I just look at their track record. How long have they been raising their dividends? Yeah. And you know, other things like how dominant they are over their industry. What are their competitors? What do their future look like? I stay up to date with like the current news. I read a lot of news articles, or at least I try to. And I listen to a lot of earnings calls whenever their earnings are released, like several times, 2, 3, 4 times, until I get the information that I'm looking for. So, and another thing, another word of advice when you're investing in a dividend stock is to, you know, regardless of if it's up or down, if it goes down a whole bunch, don't sell out just because you're feeling a certain type of way, or you watch somebody's video on YouTube and they're selling it. Don't do it because you're feeling emotional about it, or because you see somebody else do it. Because everybody, they have their own reasons, and your basis should be off of information and not emotions. Because if you're basing the decisions off emotions, it's most likely going to be the wrong decision. So don't do that. If the fundamentals of the company change and you're not willing to hold it anymore, then you should sell it. I only sell, I normally sell when something I really don't like happens, like a dividend cut, or you know, something along that nature, because that's one of the things I look for. Just me personally. I'm not saying everybody, but because I feel that my money can be used elsewhere better, and I normally put it into another similar stock. I have a lot of tech related stocks in my portfolio, and that's not even on purpose. It's just I find good quality, good value in the tech sector. Like for instance, I don't have this stock, but I love Microsoft, as a lot of people do. Apple was once that one go-to stock that everybody went to, and now they're taken over by Microsoft. That's one of the more popular stocks in the stock market because you just get everything with that company. You get it's a $1 trillion company. It might be 2 trillion now, 2.5 or something like that. But it's so dominant over its sector. You know, they sell the Microsoft Office, PowerPoint, Word. They sell all of that good stuff, as well as they dabble into the social media platform with LinkedIn, which is very important, and I don't think that's really going anywhere because they have like, you get to look for jobs on there. You have all type of connecting opportunities with other professional people. You know, it encourages you to go out and be better. As a result, you know, dress up, just keep it professional. And I like the platform. I actually need to use it some more. But yeah, Microsoft is in pretty much everything. One time they had a phone. I'm sure they have laptops. Oh yeah, they do have laptops. So they have the Microsoft Surface. That's been a very popular product, and I've been wanting that for a long time. Actually, I think I actually just won a Microsoft Surface, just the laptop, from my job some months ago. But I still haven't opened it yet. But probably because I always use my phone for recording and different type of video editing. But that's besides the point. Microsoft is a great company, a great stock to own. I always encourage you to do your own research. They're gonna. Another thing I look for is, you know, are they gonna be around for the next 5, 10, 15, 20 years? Because you want the company that you're invested into to be around for a long time, to keep increasing their revenue, their profits. And you got to look at those type of things. Also, speaking of profits, I look at profit margins. You know, it's going to vary from sector to sector with businesses. You know, typically the restaurant and like the retail business, they have very low margins. Like for instance, Walmart, I think their margins are like sometimes under 5%. And you would look at that and say it's very low, but Walmart has other ways. They have ways of making their money, even if it's not a lot. And it's just a different type of business. It's a norm for that type of business. And then you move on to like credit card companies and semiconductors, which have much, much higher margins. I think they can range from like 15, 20, 25, even 30% with some of these companies. That's very attractive. Like, I think Visa and MasterCard have some of the highest margins that I've seen. I think it's like in the 30-ish%. When I seen that, I was like, man, they really aren't paying out nothing. These credit card companies aren't. They don't really have expenses like that. They have so many partners with so many different banks and so many different television advertisements, and partner with the stores, you know, big things like that. And they just don't pay nothing really in promotion like that. So they're great companies to look into naturally, because you know, if anything, people are going to continue spending regardless, whether it be in person in the store or online. They're going to use them credit cards, them debit cards, you know, things like that. So that isn't going anywhere for a very long time, regardless of crypto or whatever you hear about that. which I don't dabble into. I did once, but I got out of it because it's just too risky and I don't understand it. And I shouldn't have started in the first place without fully understanding it. Because I feel, you know, with crypto, I really don't have nothing tangible to tie that back to. So it just wasn't a good investment for me, you know. And then I got into dividend investing and I loved it. So another good company is, I'm naming a bunch. Another good company is Lockheed Martin, ticker symbol LMT. It's an aerospace company. I think they partner with NASA and they make like some of the tech that NASA has as well as the US military. So they receive all the time all type of military contracts and grants and different things like that. So money is really never an issue with Lockheed Martin, especially when they have the US government backing them. So they're really not going anywhere. They have all type of, I mean, this company is so valuable. It's literally the US defense. They rely so heavy on them that it's not likely that they're going to go anywhere for the next 25, 30 years. But I gotta get some water. But yeah, they're gonna be around for a very long time. I don't see them going anywhere. And it was a stock that I used to own, actually. But it got a little bit too expensive. And I seen like a better opportunity on the market. Excuse me. I seen a better opportunity on the market where I could place my money into. I bought it back when that big dip back in, I think 2021 or something like that, when it dipped down to ridiculous prices. It was down like probably like $100 from where it's at right now or more. Ridiculously cheap. And you know, I sold when it went up, maybe like $50 or something like that. But I still love that company, and I may get back in the future. And they have decent margins. They have a lot of assets. I think they have more assets than liabilities. But yeah, these were just some companies that I think are worth checking out, doing some research on, maybe add it to your watch list at the very least. If you're a dividend investor, or if you just like the companies. So, you know, my investment strategy hasn't changed. Oh, as of recently, it's changed over the years. You know, I went from growth to trying to trade, and then I went to crypto. Like I said before, I was dabbling in that, but that wasn't really working out for me. So I went to dividend investing, and I just did dividend invest in my Roth IRA. I'm trying to build that, as well as pay down debt, my credit card debt, student loans, you know, things like that. So, you know, I'm investing for the long term. I'm not planning on selling any stocks. I'm really planning on adding it to it. You know, I have 5 stocks in my Roth IRA. Let's see if I can do this off the top of my head. So I got Qualcomm, Visa, T. Rowe Price, Taiwan Semiconductor, and CVS. There we go. First try. And those are all companies that you should check out as well. Those are great companies, great balance sheets, you know, all of that good stuff. But you know, I want to thank y'all for watching. Make sure to like and subscribe and join the family. We're trying to reach 100 subscribers over here. So Any subscription would be appreciated. But don't subscribe unless you like this type of content. I just want to say thank y'all for watching, and I love y'all. Hope y'all have a good rest of your day, and peace.